you structure a deal financially and legally?
So usually, when we get to the structuring part of the deal, there's been a purchase price agreed on, and everybody's agreed that they want to close. A lot of times, the parties aren't exactly sure how they want to structure the deal, the entities that are actually going to be involved in the deal, and how to go about it. So we usually get plugged in at that point to start working on that structure and coming up with a structure. From our perspective, a lot of times that structure will be tax driven. It's also a lot of times operationally driven. So if the company has a lot of goodwill in the transaction, a lot of times services companies, there's a big opportunity to do a stock deal that we can structure as an asset deal for tax purposes and get a significant tax advantage out of it for our client if they're the buyer, by doing it that way. And there's a number of different ways that we can structure deals like that with Section 338 elections or F reorganizations, a number of different ways to do it. So the tax side of it, a lot of times, has an implication in it. Also, the capital gains versus ordinary income that clients are going to pay at the end of the day, or if it's a C corporation using personal goodwill in the transaction structure in order to get capital gains treatment and avoid some of the double taxation. So there's a lot of different ways to do it. Operationally, there's also advantages to doing a stock sale and not having to transfer all the assets, but then there's risk associated with that. So uh, financially, though, these things are all factors in the financial structure of the deal, but the financial structure of the deal ultimately puts the guardrails on what we do.
I agree, Andy. I think we're representing founders who are usually buying businesses. So the view, we look at it through the prism of what's best for them in terms of what to buy. Is it the assets of the target company or the stock of the target company? And there's various considerations, as you mentioned, with respect to the tax positions and the basis for our clients. When I think of financial structuring, though, I think of all of our clients have a vision of where they want to go long term. They're at one size, let's say they're a $5 million EBITDA company, and they may have a vision to get to 20 million of EBITDA. And so they need somebody to translate that vision into financial structure. And financial structure is sort of a multifaceted word in that when somebody comes to me and tells me what they want to do, what my firm does at Attract Capital is we're able to, with our experience, tell them the type of capital that they need to raise in the amount that they need to raise it, the different lenders to raise it from, whether or not they can raise it all as a loan, or whether they need to bring some of it in as preferred equity, structured equity. So what we're able to do is if somebody tells me what they want to do, and it could be any deal, any possible deal. It could be a company that's growing just on its own and needs more growth capital in order to expand, or it can be somebody that's acquiring as a way of expanding. We can look at their existing capital. We can look at their balance sheet. We could look at their P&L, and we can hear what they want to say, and we can come up with the financial structure that balances their preference for risk with the capital that's available in the market at certain pricing points. And so a lot of times people come to us and say, we want to buy a company. And I'm like, okay, do you just want to buy one company? Well, I want to buy this company first, but then we want to buy 3 more companies. And so when they tell me that's their vision, I know exactly what loan structure to put them into. And so it really comes down to financial structuring comes down to the fundamentals of being able to analyze and map out the capital need of the client with various cash flow structuring techniques, which is what we've done at Attract Capital for the last 25 years and why we've been successful with our middle market companies, our founder-owned companies, because they don't know how much money they can raise from this particular type of lender, or whether they're still within a loan or if they're over the edge and they need to bring in equity. Those are the considerations that we bring to the table. So it's kind of an open-ended, creative way of looking at um, designing a bespoke structure for their particular need.
I think that's very true. And one of the early discussions we have is what is that future plan? Because that really factors into how we structure the deal from an entity perspective, especially a lot of times. And if they're doing those bolt-on acquisitions, there's structures that we use to facilitate that. Uh, and if their financial, if their loan structure is going to have an accordion feature that we know we're going to be dealing with that lender in the future, or are they going to have to look for other lenders for future acquisitions? It affects how we set up the company structure from the beginning. But having that early kind of future strategy, future outlook discussion helps to formulate the structure that we use and try to put them in going forward.
I agree. And it's like baking in the scalability of their capital um, demand, baking that in into the front end. And a lot of times where our clients struggle is that I'll tell them they have to be at a certain size before they can take advantage of a unitranche strategy with a delayed draw term loan. So a unitranche delayed draw term loan will give them all the money they need to execute their roll up, but they have to be big enough to start. So it's considerations like that. One of the things we talk about with our clients is the keystone acquisition, which is usually the first deal that they're starting with, and making sure that that's big enough so that a lender can make a loan against that company, that it's sizable enough. But I agree, financial structure is critical. If you're going down the road and you haven't really thought about financial structure, you need to stop. You need to you need to get some people on your team that understand it, and you need to have a conversation about it, because you don't want to do a one-off deal that you're just going to have to unwind 6 months down the road.
Right, and it's also important as part of that to think about the exit strategy as well. And from our perspective, we're often thinking about what are the tax implications of the exit strategy. And if we, for example, if we have a non-services company and we put them in a C corp structure, there's ways to significantly reduce capital gains on an exit by doing that. So knowing what the goals are for the future, and thinking about the exit in the future too is helpful.
Agreed.